Have you noticed that banks seem to be reporting record profits, while at the same time, it feels like everyone you know is struggling with debt? You're often told it's just about your personal spending habits. But what if the system itself is designed to keep you in the red? In the next few minutes, I'm going to show you exactly how banks have engineered a system to make your debt more expensive. This is the hidden truth they don't want you to know. Section 1. The problem. It feels like you can't get ahead, right? You work hard, you try to pay your bills on time, but that credit card balance never seems to shrink, and your savings account is earning practically nothing. It's a frustration millions of people feel every single day. You might look at your statements and blame yourself, thinking you just need to cut back even more. But while you're pinching pennies, the banks you owe are having some of their best years ever. In the second quarter of 2025, total U.S. household debt hit a record $18.39 trillion. And banks have found a way to make that debt more profitable than ever. While the sheer amount of debt is at a record, the actual burden on households relative to income isn't at an all-time high, which shows just how much the system has been fine-tuned. The story you're being told that it's all on you is missing the biggest piece of the puzzle. The real story is about how your financial struggles have been turned into their record-breaking success. Section 2. The hidden engine. So how exactly are they doing it? The answer is a little something called the APR margin. Think of it as the bank's secret markup on your credit card's interest rate. Over the last decade, the average APR on credit cards has skyrocketed, climbing from around 13% to over 22%. But here's the kicker. This isn't just because the Federal Reserve raised rates. Banks aggressively widened their own profit margin on top of that. This APR margin is now at the highest point in recent history, according to a report from the Consumer Financial Protection Bureau. This practice allowed major credit card issuers to charge an estimated extra $25 billion in interest in just 1 year. For the average person carrying a balance, this hidden margin cost them over $250 in extra interest that year. And this isn't just about having bad credit. The CFPB found that even if you have a perfect credit score of 800 or above your APR, margins still likely went up significantly, with no corresponding increase in risk for the bank. They're not charging you more because you're a risky borrower. They're charging you more because they can. This extra interest gets baked into your minimum payments, making it harder and harder to pay down the actual principal and trapping many in a cycle of persistent debt. Section 3. It's not just credit cards. This isn't a one-trick pony. The credit card APR margin is just the most obvious example of a much wider strategy. First, there's the massive gap between what banks pay you on savings and what they charge you on loans. Banks have kept the interest rates on savings accounts incredibly low, even while the rates they charge for loans remain high. Your savings might earn a tiny fraction of a percent, while they lend that same money out for mortgages, car loans, and credit cards at a much, much higher rate. That spread is a huge source of profit for them. Second, banks are getting more creative with fees, from monthly account maintenance to overdraft fees and other service charges. Banks are increasingly looking for ways to generate non-interest income. Some major banks even charge a monthly fee just for the privilege of having a savings account. Finally, there's a staggering lack of competition. Just a handful of large issuers control the vast majority of all credit card debt. This market concentration means they don't have to compete aggressively on price. In fact, reports show that the 25 largest credit card issuers charge interest rates that are 8 to 10%, points higher than smaller banks and credit unions. For a consumer with an average balance, that difference can cost an extra $400 to $500 a year. Section 4. The solution. How to fight back. Knowing this, you no longer have to play their game blindfolded. You can take back control, and it starts with being proactive. First, investigate your own accounts. What is the APR on your credit card? If it's over 20%, you are paying a huge premium for that debt. Don't just accept it. Second, shop around. The data is clear. Smaller banks and credit unions consistently offer lower interest rates. That difference of 8 to 10 percentage points could save you hundreds, if not thousands of dollars. Credit unions, in particular, are not-for-profit institutions and often have significantly lower rates. Third, if you have a good payment history, call your current credit card company and ask for a lower rate. A survey found that 83% of cardholders who asked for a lower APR were successful. Mention that you're considering a competitor's better offer. You'd be surprised how often they're willing to negotiate to keep a reliable customer. The system may be tilted in their favor, but it doesn't have to be a losing game for you. Financial knowledge is your best defense. If you want to keep learning how to navigate this system and take back control of your money, make sure you subscribe and hit that notification bell. And now, I want to hear from you. Have you had success negotiating a lower rate, or have you found a better deal with a smaller bank or credit union? Let me know in the comments below. To conclude, the truth is, banks often prosper by making your debt expensive and your savings unproductive. They have built a system that profits from a PR margin expansion, fees, and a lack of real competition. But by understanding how it works, by checking your rates, exploring smaller banks, and being willing to negotiate, you can refuse to be just another number in their profit reports. It's your money. It's time you made it work for you, not for them. Thanks for watching, and see you in the next video.